All right. Weekly Roundup, Season 2, Episode 1, also known as, what is that, January 7th, 2022. Ben, we made it
We did.
over the gap.
That's it.
What do you think?
2022. I saw somebody make a reference that they were saying it's 2020 take two. So we're hoping that's not the case.
Oh, man. I know. It started out to be, hasn't it?
Yeah, it really has been. Yeah.
No kidding.
Yeah.
So a couple things, just to start a couple housekeeping things. As usual, if you want to ask a question, just hit the Q&A button at the bottom there. Type it in or raise your hand if you want to do audio, as usual. We did actually get an email question today, so we'll cover that as well. You can send in your questions ahead of time if there's something you want us to touch on that week or something that's piqued your interest you want Ben to cover. Definitely email that in ahead of time. It's probably even a better way to do it. Yep. The other thing is we're fast approaching RSP season. So even though we do have quite a bit of time, I believe it's the end of March.
Start of March.
I mean, sorry. It's always best, as you can imagine, we have a lot of clients, so it's always best to get your contributions in as soon as possible. Right? May as well get them done now, and then you don't have to worry about it.
For sure. And we've started making TFSA contributions already for people that have spoken with us. And we have a number of people that want us to just go ahead and do it out of the gate. So if you're not one of those people, certainly let us know as well. And we'll do the TFSA contribution either from your investment account or from your bank account. So certainly let us know on that as well.
Yep, for sure.
Yep.
Okay, Ben. Well, how are we starting off 2022? What have you been up to? What have you seen in the world this week that piques your interest besides crypto taking a bit of a nosedive here?
Yeah, I mean, I think it's been, as I was just looking before we came on here, I just wanted to see where we were, how the week closed out for most of the major indices. And as you probably know, it's been a rocky start to the year. Look across the board, I don't see anything in the black except for the US dollar versus the Canadian dollar. That's the only thing that's up over this first few trading sessions of the year. Everything else is on the red side, with and to your point, crypto leading the way to the downside, down about 10-12% year to date. Nasdaq down 4 or 5% year to date, and then S&P and TSX probably down about 2% year to date. So certainly not a great start to the year. We have had since, I'd say, maybe summer of last year. We've had a lot of choppiness in the markets. November, December were continued to be pretty ugly as well. And we haven't started off the year super great here, but some of the economic indicators that I've been talking about, where I said, at least I felt my view was that inflation peaked and growth is probably peaking this quarter. At least the numbers that we see coming out seem to further support that that's the case. And so we saw lots of action for the first week of January, and central bank meeting or minutes came out this week, which caused the markets to have a bit of a panic so far.
Mm-hmm. Nothing surprising, I mean, from our standpoint though, right? Like you pretty much were anticipating this kind of early on, this kind of temperature early on in the markets.
I'd say this is a bit early. Like the first week, I was a bit surprised to see that the minutes scared everybody on Wednesday. So the Fed releases their minutes from December, and that seemed to kind of scare everybody. And so it's a bit interesting how we've traded this week, where we've seen kind of everything sell off. I'll even look at bonds. Bonds are down as well. So you got stocks down, bonds down, you got crypto down, and the only thing I think you have up this week at least is the US dollar. Even gold's down in Canadian dollar terms year to date. So that setup definitely is telling you that something's changed. And I think the next step is, is this a buy the dip moment, or is this the bond market's actually telling you that things aren't going to happen like we'd expect them to happen, and it presents an opportunity to do things, some of the things that I did this week. So it was a little bit surprising, some of the weakness in certain sectors, but I think this is presented a pretty great opportunity from the perspective that I didn't think yields would get here again where they are. So if I'm right on the economic picture, then it's a good time to add to bonds.
Right. Okay, well, that's a good segue into, so what did you get up to this week as far as the portfolios are concerned?
Yeah, so added to bonds, definitely. Some to the 10-year, the IEF, which is the 7 to 10-year US, and also the 30-year. And so that would be TLT, which is ETF. And so if you look at really kind of where bond yields were last summer, we'll say about August, probably August 20, yeah, bonds are about a full percentage point higher than where they were then. And so that's really kind of all the way across the curve, right? 2 years have gone from 1 to 126, 10 years gone from 1.5, or sorry, 0.7 to 1.7, and then in the long end you've gone up to about 2% as well. So you've had a big shift in the yield curve in anticipation that rates are going to rise. And then what we saw this week, I think Henry has a question there, but what we saw this week is that they came out with their minutes. Maybe we're going to go a little bit faster because things are good. And then what we saw this morning was we saw a big jobs miss. So the market is like, what the heck? And so a bit of a panicky week with central bank policy, but I'd expect the central banks come back and kind of walk back some of their aggressive comments, and that kind of puts a floor under this kind of current move. Yeah, so added to that, reduced a little bit of small cap that I still have, continue to want to do that as well as the opportunities are presented, because Q2, I'm about as certain as I've been in a while that growth and inflation slow together in Q2, and if U.S. central bank raises rates aggressively, that's going to speed up the slowdown and make the equity sell off faster.
Gotcha.
Yep.
Yeah, so Henry did have a question. So he wanted to know, over the calendar year, how did crypto do versus the S&P?
Bitcoin was up about 46%. S&P was up 20. Ethereum was up about 460% last year. So.
Okay.
Yep.
That's quite significant.
Obviously, volatility is different, risk, all these other things, but from a pure numbers perspective, yeah, it's been a big number. It's compounded at around 20 since inception, but it's an 80 volatility asset class. We've seen a sell off of about 40% from November highs to where we are today. So it's quite volatile. But if you look historically, if we hold these levels, which it looks like we did today, what you're getting from a trend line perspective is you're getting higher lows. And so if you're getting higher lows, that means the trend is moving in an upward trajectory. So from a technical perspective, looks quite good. Goldman Sachs came out this week, and Goldman tends to be one that people follow quite a bit still, whether you like them or not. What came out and said their kind of view is that Bitcoin is potentially replacing gold as a store of value. And they say kind of compounded returns over the next 8 years to 2030, that we're going to compound around 20% a year to that point, taking you up to the kind of the 100,000 level. Some people say that's really too low or not, but based on their analysis, they think that that's kind of the view and kind of where it fits from a rate of return perspective.
Okay.
Yep.
You did mention gold in there too, so it might be a good segue into our email question from Eric, which was just wondering what the outlook for energy and precious metals would be.
Yeah, so my view on energy is that I think that we have, I think inflation has peaked. I think energy has peaked. And I still think it probably is an elevated level, but I think we've peaked. And so energy is a no for me for right now, certainly for the next 6-9 months. So I think it's not the place you want to be. If inflation's slowing, kind of commodities across most of the spectrum are not ideally the place you want to be. I think you got to sell the rallies, and if they're presented. As for gold, historically, this has been a pretty good setup for gold, where we're in this, inflation slowing, gold's growth continue to accelerate a little bit. We're seeing bond yields move up to the top end of the range, which I say this 170 level on the US 10-year. And gold down to the bottom end of the range. This is typically a good time where you want to be probably buy bonds and buy gold. And when those two narratives kind of move together, where yields are coming down, gold should do well in that backdrop. So I like gold right now, certainly over the next 3 months. And I have had questions about gold miners as well. And so again, if your view is that you got a reasonable setup for gold, then the miners offer that potential alpha, potential risk reward setup. That's good too, where if you just want to own gold and be safe, maybe you get 4 to 6, but if you want to buy some of the miners, you maybe you get 6, 12, 15. If you go down the spectrum to juniors, you probably you can kind of extrapolate that number if the trend in gold plays out the way I expect.
Great. Hopefully that answers your question, Eric. If you have a follow-up, just put it in the, I notice you're in here, so just put it in the Q&A there. We'll be happy to follow that up. Should we get into the first edition of Ben's charts for season 2?
Yeah, sounds good. Sounds good.
Right.
Let's see if we can have a smooth transition this time.
I know. Well, I heard you stayed within the rule of 3 charts this week, so that's first for everything.
First, yeah, there's just so much at the start of every year, so many charts, so many decks to look at, so much research that comes out that, I was looking through, I think I'm up to about 150 pages of just the views from all the different investment banks throughout the world. What do they think about energy? What do they think about commodities, interest rates, the economy? Everyone's got different timelines, but certainly there's so much to dig into and go through. But so I kept it to 3, kept it real short. This is all JP Morgan material charts today. Tried to keep it simple, but really wanted to talk about a number of things. I've mentioned a few of my dailies on valuations. If anyone cares about that, stock concentration in the indices and ETFs, and just wanted to talk a little bit about the economy and consumption and things like that. So starting off the first chart with the valuations. And so this is from 96 to today, and it's a look at kind of earnings, like price earnings, dividend yield, CAPE, which is the Case-Shiller price earnings. So they try to adjust those metrics. And what I wanted to point out in the charts here is that if we look at these are the kind of the long-term averages right across the middle. And what's interesting on the chart here is it shows how many standard deviations we are above the longer term average. And so from a pure price earnings perspective, we're about 1.3 times standard deviation over long-term average from a pure price earnings. If we actually look at a breakdown of those price earnings, the top 10 companies that are driving returns right now actually are trading at about a 33 multiple, or the bottom 490 companies are trading at a much more attractive multiple than that, around 15. Case-Shiller 40 times. Interesting thing about Case is they tend to also give you projected potential returns over the next decade based on these historics. And so, obviously at stream levels, 2 standard deviations above our long-term average. Price to cash flow, price to book, these are all around two standard deviations above their longer term averages. So important, I think, metrics to pay attention to. And whether we like them or not, I think valuations ultimately will matter. And you got a massive disconnect between US stocks and global stocks from a valuations perspective. So this is something that's, I think, worth paying attention to at this point. Makes sense?
Yeah,
Yep.
absolutely.
All right, get the next one here. So 2 kind of different things. I guess maybe these are 3 charts into or 4 charts into three slides.
Always looking to cheat the system, Ben.
Exactly. So let's just look at the one on the right hand side first, which is the weight of the top 10 stocks in the S&P 500. And so, I talk about it, but visually it's interesting to look at it this way. At least for my career anyways, we're at an all-time high. And if you look at the other all-time highs where we have these other various peaks, you probably know what happened in 2000, know what happened in 2008, probably know what happened around these levels as well. So now we're reaching again these super concentrated stock returns being driven by these handful of 10 companies. Ultimately, it tends to result in potentially some greater potholes. As for anyone that remembers, Nortel in Canada made up, I think, 40% of the stock market at one point. So there's some risks there. The other thing, which on the left-hand side, which is the profit margins for the companies in the US. And so, we've been talking about inflation and rising costs and supply chain and all this kind of BS that I think a lot of these companies have been talking about, saying, it's such a hard time for us right now. We have to raise prices just to keep up with demand and keep up with all these issues. Yet, we got kind of historic profit margins for these companies in the US. So something doesn't match up. How can you have maximum profit margins, but you're getting squeezed on your input costs? That doesn't make any sense. So I guess when we look at these numbers, you get these huge profit margins. I don't think these are sustainable. Certainly, if you continue to keep complaining about not having staff and things like that, if you want to be able to hire people, if this is something that happens, the likelihood that these profit margins are sustained are pretty low at this point.
Yeah, definitely. All right.
Last one.
All right.
Last one. So, this was just more of a long-term growth chart on GDP, but the thing that caught my interest, and I'm sure a lot of people probably know these numbers and statistics already, but when you look at the composition of GDP in Q3 in 2021, you probably know this inherently, but 70% of GDP in the US is consumption. So that's a huge number. And so when you worry about why there's so much talk about the consumer in the US, Canada has a similar breakdown as well. But when they talk about the consumer and kind of continuing to make sure that the consumer is in good shape, and they put out a lot of these statistics to say that the consumer is healthy, lots of money in the bank accounts. Those numbers are definitely skewed, but consumption is a big part of it. Obviously, government spending is, as you see, 18% of GDP. Again, this is not healthy, I would say, from an economic perspective. If the consumer makes up this much of the economy, and the consumer is probably not in as good a shape as everyone expects, if we get slowing GDP, You get the government reining in costs. You get FOMC, running their balance sheet off, raising rates. It's not a great setup right now to own some of the riskier stocks. So a lot of the things that I've been doing is regrading the portfolio, moving up the quality, increasing some bonds, staying with US dollars, which was a bit of a drag in portfolios last year. A lot of these things I think are going to be very good performers. And I think on the last call we had at the end of last year, I said, the surprise maybe for 2022 is that bonds could do better than stocks. So kind of sticking with that, at least in the first half of this year. And so that's what's grabbing my attention right now.
Right. So you mentioned, that's not a good mix. What would you like to see the averages be? Is there like specific numbers or specific ratio they should be looking at?
Yeah, so I would say I think one of the things that a lot of economists have been looking at is the rising consumer in some of the emerging markets. And so, I think what is the right balance is a great question. I don't know that there is a simple one, but I think a lot of it has to do with the rate of change of that. And so, China's been increasing they passed 50% kind of consumption a couple of years ago. And so, I think that from a health of the economy perspective, I think that just based on my view is probably want that number to be a little bit lower. You don't want consumption to be the big driver. And it's the direction, I suppose, that how innovative the country is being, and the U.S. has really prided themselves and succeeded based on being kind of leaders in technology, and they export that technology. And it looks like right now that's certainly not the case.
Mm-hmm. Okay, great. Well, that's a pretty good deck for the first one of the year. Good job.
Yeah.
All right, no questions on that so far. So what are we looking ahead to for next week?
Yeah, so based on how this week has played out, I think that today, where there's kind of the headline jobs miss, we'll say, it potentially gives the central bank some cover to come out and say, you know what, maybe we were wrong in our comments in February or in December. And if they do that, which I think is a high likelihood, at least one or two of the members will speak next week. Say something like, maybe we aren't going to go 4 times, maybe we'll go 3 times. If they say something like that, it really changes the narrative a lot. And I think that's likely. If it's not next week, I believe it's going to be sometime this month, where they're going to point it out and say, actually, things aren't quite as great as we thought. So it gives them a chance to kind of pull back. And what that would do, it's going to bring yields down, probably bring tech stocks starting to pick up again. But it's not going to change the trajectory of inflation or anything like that. But it should bring bond yields down, bring some of the technology growth stocks back. But I do think that into Q2 of this year, we see growth and inflation slowing together. The pace at which that happens really depends on what the central banks do.
Gotcha. Okay, we got another question. Lyle here. Canada's GDP is 30% based on trade, and the last few quarters have shown a growing surplus in the balance of trade. So how does that affect the GDP profile and components?
Yeah, so I think that because we're a country so driven off our natural resources and exporting our natural resources and energy, I think across the board has peaked. I have to think that it's not going to be a positive for Canada. I would say, from a global country perspective, the Canadian economy is super tied to the US. And if we see growth and inflation slowing together, that's going to happen in Canada as well, maybe a little bit faster because of the commodity base that we have. And depending on what happens with real estate in Canada too, some of the prognosticators in Canada, I saw BMO came out with a report today that said, housing prices in Canada should be 30% lower than where they are today. So, I got to think if they're putting these reports out, they're kind of signaling to the Bank of Canada to say, let's take it easy. Let's not go as aggressively on rates as we thought. So, with commodities and housing be the big drivers of Canada, I'd say it's not going to be positive for Canada.
Gotcha.
Yep.
Okay, good. Thanks for the questions there, guys. It's always good when you guys interact. Okay. Anything else that you want to touch on before we wrap it up for the week?
I don't think so. Continue to let us know if you need anything. We've started to go through with booking meetings for the start of this year. If there is something urgent, you need to talk to us and send us an email. We are trying to use our new email. And maybe Scott, you can message what that email address is. That comes to all three of us, and so that would come to Joy, Scott, and myself. That if you need to book something, you need something urgently booked, all three can book a meeting in to have a discussion with me or touch base. So certainly we're going to continue to work on getting things set up for this year. I am planning to do, like I do every year, an annual look back, annual look ahead, which you haven't firmed up on the date yet. But we certainly will. We'll do that shortly, probably the last week of January. I think we would book in that live stream.
Sure, we could probably shore up the date next week. We didn't have a chance to chat about it there.
Yeah.
I'm just going to put the email address that we're using moving forward this week, and I think Ben's going to send an email about it next week, is service.heart@nbc.ca. I'm just trying to put it in the
notes.
In the notes here.
Yep.
But like I said, we'll send a note out on that. That's good because it goes to whoever's available first, or whoever it's directed to, right? So
Yep.
we can get you the best person. That way too, as the team grows and changes, if somebody comes in or out, you don't have to be guessing with who you're, who should I email for that? Is it Scott? Is it Ben? Is it Joy? Is it this new person? Whatever it is, right? So it's one central place.
Yep.
So that's great. Awesome, Ben. Good start to the year.
Nice work. Yeah.
Yeah. Good stuff. Okay, everybody. Well, if there's nothing else, I don't see any more questions here. Have a great week, and we'll talk to you next week.
Thanks. Take care.
Okay, bye now.